What if I told you that the people who make the most money in the market don't trade to win? The world's best traders think like losers. They don't fantasize about Ferraris or chase a high win rate. Instead, they do something the average trader can't stomach. They rehearse losing. They plan for it. They welcome it. Not because they enjoy pain, but because they have learned the market's most important lesson. That pain is the only prize for clarity, and loss is the only path to real control. Most people come to trading hoping to escape discomfort, but the ones who thrive are those who let fear do its job. They don't suppress it, they study it. Trading is not a game of signals and timing. It's a mirror that reflects everything inside you. Your fear of being wrong, your need for validation, your impatience, and your greed. When you place a trade, the market asks you, are you in control of yourself, or are you still chasing the ghost of your last loss? Most traders fail because they never learned how to suffer well. But the best ones have made peace with losing, built muscle where others feel fear, and mastered the art of doing the hard thing calmly. This is not about motivation. This is about transformation. If you're ready to see what losing means and why it might be your only real advantage, then what follows will flip everything you thought you knew. Because in this world, the best loser always wins. The psychological paradox of losing. There's a fundamental lie that most traders are sold. If you find the perfect strategy, you'll win. This promise is a setup for failure. It creates an unspoken rule that losing is a sign that you did something wrong. As professional trader Tom Hoggard discovered after a devastating 127,000-pound loss, the need to win is the most dangerous addiction in trading. It clouds judgment, hijacks discipline, and makes you chase setups that aren't there. The market owes you nothing. The more you expect from it, the more it takes. The traders who last are not those who seek to win more, but those who have reframed what losing means. They shift from how do I avoid losing to how do I become stronger through it? This internal battle is deeply biological. Your brain is a 200,000-year-old survival machine, not a modern strategy computer. Every time you feel fear during a trade, it's not a rational response to a market movement. It's your amygdala, the brain's panic button, screaming that you're in danger. Tom's heart rate spiked from a normal 65 BPM to 138 BPM during a losing trade, proving his body thought he was being chased by a predator. You're not fighting a lack of knowledge. You're fighting your ancient biology. The emotional traps, trauma, fear, and revenge. A trader's career is profoundly shaped by their first significant loss, which often goes beyond just the financial cost. This initial major loss shatters the illusion of being in complete control of the market. Before this experience, a new trader often believes their intelligence or strategy can conquer all outcomes. However, a large, unexpected loss, like a sudden flash crash, reveals the market's inherent unpredictability and a trader's vulnerability. The feeling of helplessness in that moment creates a deep-seated psychological trauma. This is how fear distorts reality. It lies to you. Fear's primary function in trading isn't just to make you nervous, it's to distort your perception of reality. It works by creating a false narrative that directly contradicts your research and data. In Tom's case, his system and analysis indicated a buy signal on a perfect setup. However, the emotional discomfort of potentially being wrong caused fear to whisper, "It's a trap." This internal voice, born from the anxiety of risking capital, made him second-guess his proven methodology. The consequence was that he missed a 200-pip move, not because his strategy was flawed, but because fear made him disbelieve his successful data and ultimately forget the very plan he had spent time building. It hijacks your body. Trading is not just a mental game. It's a full-body experience. When a trade goes against you, fear triggers a primal fight or flight response, which physically hijacks your body to prepare for a perceived threat. Tom's experiment of recording himself revealed this perfectly. His pupils dilated, his breathing became shallow, and his heart rate spiked. This physiological takeover floods the body with stress hormones like cortisol, causing tunnel vision and making calm, rational thought nearly impossible. In this state, a trader's focus shifts from executing a precise plan to simply surviving, leading to impulsive actions like cutting a winner too early or holding a loser too long. It fuels revenge. Revenge trading is a powerful and destructive emotional spiral that starts when a loss feels like a personal insult rather than a calculated risk. It's the moment a trader's ego feels attacked and their logic completely breaks. When a perfect setup fails, it can feel as if the market has wronged them, triggering a powerful urge to retaliate and get their money back. Tom's experience is a stark example. After a small loss, the feeling of being wronged pushed him to abandon his system, triple his position size, and trade out of pure anger. This emotional hijacking led to a complete breakdown of discipline, costing him an entire year's profit in a matter of hours. The wall of shame, with its constant reminder of the high cost of emotional decisions, became his tool to prevent this self-destructive cycle. The professional's toolkit, practicing pain and building resilience. The best traders have a toolkit of techniques and systems to master their emotions and build resilience, understanding that willpower alone is not enough to survive the market's psychological pressures. They use an emotional circuit breaker, such as a physical action or a built-in delay, to interrupt the emotional spiral of fear and greed before it leads to a bad trade. Their journal serves as an emotional autopsy, documenting not just the numbers but also their feelings, which allows them to identify and learn from subconscious behavioral patterns. They also engage in deliberate practice through simulators and even loss therapy to desensitize themselves to the pain of losing, building the muscle memory required to remain calm under pressure. Finally, they use visual cues like a wall of shame or a core mantra to reinforce their commitment to a disciplined process, ensuring that their plan, and not their emotions, is always in control. The emotional circuit breaker. The emotional circuit breaker is a powerful technique designed to prevent impulsive trading decisions by creating a deliberate pause between an emotional impulse and a physical action. When a trader feels pressure building, the urge to chase a trade or panic exit, they use a pre-planned circuit breaker to interrupt the emotional spell. This could be a physical act, like standing up and audibly verbalizing a warning to themselves, as Tom Hooger did. This simple, conscious interruption breaks the subconscious reflexive response. Another effective method is to use a technical tool, like a 60-second delay on the trading platform, which forces the trader to stop and critically evaluate their decision by asking specific questions. This brief moment of reflection allows the rational part of the brain to re-engage, ensuring the trade is based on a sound plan, not on an emotional whim. Loss therapy. Loss therapy is a counterintuitive and radical approach to desensitizing oneself to the pain of losing money. The core idea is that a trader's nervous system often overreacts to losses, leading to impulsive, irrational decisions. To address this, Tom Hooger intentionally exposed himself to the feeling of loss in a controlled environment. He would take valid trade setups in a small, separate account, but use massive position sizes, guaranteeing a loss. By experiencing the pain of losing repeatedly in a safe, methodical way, his nervous system gradually stopped treating each loss as a new threat. This process of deliberate exposure effectively inoculates the trader against the emotional sting of a real loss, allowing them to remain calm and disciplined when their strategy experiences an inevitable drawdown. Simulated pain builds real power. Professional traders don't just practice their strategy. They practice their emotional responses to stress and failure through simulation. This goes beyond simply backtesting a strategy on historical charts. Instead, they run historical simulations as if they were live, actively making trades and managing a simulated account. The key insight is that the most valuable part of this exercise isn't the simulated profit and loss. It's the emotional tracking. As Tom Hooger discovered, typing out his feelings and emotions during these simulations, "I'm getting angry at this pullback. I want a revenge trade right now," created a map of his emotional triggers. When those same emotions arise in a live trading environment, he can instantly recognize them and manage them, transforming simulation from a strategic exercise into a powerful tool for building emotional resilience. The journal as an emotional autopsy. A professional's journal is a critical tool for self-mastery, serving as an emotional autopsy of their behavior. Unlike a simple trade log that tracks entries and exits, this journal documents not just the market data, but also the trader's emotional state before, during, and after each trade. By meticulously recording their feelings, the trader can identify recurring psychological patterns that lead to bad decisions. For example, Tom Hooger found a pattern of overtrading every January and revenge trading every December, a self-destructive cycle he only saw after consistent journaling. By recognizing a phrase like, "I knew I shouldn't take this trade, but," as a costly trigger, he was able to create a rule to immediately stop trading whenever he wrote it, effectively shutting down his most dangerous behavioral flaw. The path to mastery, from trader to self-master. The journey of a trader unfolds in 3 distinct phases, each a critical step in the evolution from a novice to a professional. It begins with the excitement addiction, a stage defined by a rush of emotion, the pursuit of quick profits, and a belief that a high win rate is the key to success. In this phase, traders are often impulsive, overtrade, and view the market as a casino to be beaten, a costly approach that serves as the market's tuition fee. This reckless period inevitably leads to the night of the trading soul, a devastating phase where significant losses, self-doubt, and a shattered ego force the trader to confront their emotional weaknesses. It's a time of intense frustration and a strong urge to quit. But for those who endure, it becomes a crucible for self-reflection and personal growth. The journey culminates in the boring, beautiful phase, where the trader has finally achieved a state of calm mastery. They no longer chase excitement. They are disciplined, process-oriented, and emotionally detached from individual trades. In this stage, a well-executed plan, even one that results in a loss, is considered a success, and consistency replaces thrill as the ultimate goal, leading to sustainable and long-term profitability. For a few, trading becomes a form of spiritual practice. Tom's morning ritual sounds like it belongs in a monastery, with meditation and gratitude before he even turns on his screens. He realized he wasn't trading for money anymore. He was trading for presence, for the challenge of staying conscious when every cell wants to react. The ultimate insight is this: losing is inevitable, but suffering is optional. Loss is a built-in part of the market, a fact of the game. What separates the master from the amateur is not who avoids losses, but who stops suffering from them. After a record-breaking 23-trade losing streak, Tom had a profound moment of surrender, realizing his job wasn't to win, but to execute. He placed a post-it note on his monitor that reads, "I am paid to place orders, not to be right." The less he cared about winning, the more he won. The less he suffered from losses, the smaller they became. The market didn't change. His relationship with it transformed.